Hi everyone, this is Tim Melvin coming to you from down here on a very muggy day in Central Florida once again. Love this weather down here. It's why I moved down here. You do not ever have to shovel sunshine. The market was actually down again this week, down about 0.8% on the Dow Jones Industrial Average, while the S&P 500 was basically kind of flat for the week with I think a 0.1% gain. So far, half of the S&P companies have reported, and right now it looks better than we actually thought it might be. We've got 76% of those companies that have reported have beat expectations by about 4%. On a 6.7% year-over-year growth rate at this point, which is even above the kind of optimistic 4.9% expectation as we came into the quarter. And revenue growth right now is running about 3.2%. Now, we're only about halfway through. We'll see how much this carries forward. But so far, this is one of the best earnings seasons we've had in quite a while. In spite of that, the market has not been able to really get anything going, and there's a couple reasons for that. One, the geopolitical situation, it's bad, it's getting worse. There's just absolutely nothing great happening around the globe. The Ukraine is an absolute mess. There's had several airplanes shot down, of course, including the very controversial passenger jet. We still don't know what really happened there. Someday it'll come out, but that's still just an absolute messy situation. Still a lot of fighting on the ground and a lot still to come before this is completely done. Serious implications for the European economy, so we're watching that one rather closely. Of course, Israel and Gaza there's a lot of finger pointing and yelling, and I'm just going to stay out of that because it's so politically charged. But that's messy, and so is the situation that is still ongoing in Iraq and Syria. So lots of geopolitical concerns weighing on the market. So is something that we've talked about for several weeks. The housing numbers were horrific. New home sales were down to about 9%. That's quarter over quarter. They were also down year over year, and they revised those great May numbers. Remember those 18% or whatever it was? Yeah, they revised those down quite a bit as well. D.R. Horton came out, had sales were okay, but margins were terrible. They were basically having to almost give away new homes in order to get them sold. So the housing market's not what everybody had hoped it was going to be. And one thing that I want you guys to remember, that when you hear these numbers coming out, like the May number, for example, it was a huge increase over April. It was still down year over year compared to May of 2013. You look at a chart of housing, there's a long way to go. And I would have to say that over a decade period, I would be pretty bullish on housing. But I just don't think that this year we're going to see the type of resurgent activity that everybody was hoping for. The job situation just does not support a booming housing market. Folks thought that the housing market would bail out the economy. It's exactly the other way around. The economy is going to have to bail out the housing market by creating some real decent paying jobs. Not happening yet. Hopefully it does, before we all get too terribly much older. Housing's not the support people we're looking for, and that's kind of weighing on the market along with the geopolitical stuff. Now, when you talk about earnings, there is a bright spot. Now, as you know, I'm huge fan of the small community and the regional, little regional bank stocks, and they've kind of bumped along, and earnings have been very mixed. This quarter, so far, and I've only looked at some of the names, probably less than half in my case so far, but I'm starting to feel a little bit like a growth stock investor. These guys are coming in with just huge earnings increases. They're buying back stock, passing new buyback plans. They're instituting and raising the dividends. The sector so far, it's just been absolutely wonderful. Book values are increasing. Loan losses and the credit situation is getting better for a lot of these banks. And we're still seeing a continued pickup in merger activity. In fact, my 10 Tiny Banks report that I put out a few years ago, we had a takeover in that in the past week when Madison Bancorp out of Baltimore, really tiny little bank, it was about a $10 million market cap when we bought it, was taken over at a very nice 45% gain. Now, if you look at the 10 stocks that we originally had in there, American United has also gained 40% as they continue to expand into the Hispanic markets out in LA and have done extremely well. Now we've had a takeover. Now we've got 8 banks left in that report that are still, they're tiny, they're 8, 10, 15 million dollars in market cap, but they're trading at a little bit less on average than 70% of tangible book value, and they have pretty cool, solid balance sheets without horrible loan loss problems. So if you haven't gotten a copy of that yet, I suggest you pop on over to MarketFi and get you one. That's 8 great stock ideas that can make a huge difference for you over the next several years. Okay, end of sales pitch. as we go through the earnings season, so far we have not had any of the big blow-ups that we hope for that create value. Now, we've had some blow-ups. Ask anybody that owned Amazon coming into the earnings report this week. That got pretty ugly. But we haven't had any that created outstanding bargains at that 50 or 60% of book value, like we've seen in years past with names like Stealth Gas or Safe Bulk Shipping, or earlier this year, Boardwalk Pipeline Partners, which of course has just been a tremendous stock for us because we bought that huge 50% or so decline when they had a bad short-term earnings report. 3 months does not a company make, folks. And when we get these blow-ups that create bargains in companies that trade for less than book value and actually have a balance sheet that's going to allow them to survive long enough to thrive, these are some of the best opportunities that we get in all of investing. It's the only thing I like about earnings season. I think the rest of it's absolutely ridiculous. A quarterly snapshot is no way to run a business or a country or an investment portfolio. So anyway, looking along here, this week, of course, the Baltic Dry Index, the measure of shipping rates around the world, has fallen to 18-month lows. So it's going to come as no shock to anybody that we did buy a stock in spite of what we think are elevated market levels and everything else. This week, excuse me, a little phone went off there. Sorry about that. We bought a shipping stock as the Baltic Dry Index pushed down into 18-month lows. Just the economy globally is not as strong as everybody had hoped. China's putting out good numbers, but they're not actually ordering, a whole bunch of stuff. So shipping rates have taken a bit of a plunge, and it's creating some bargains in the shipping industry. If we're really lucky, we've got a bunch of these. Some of the leaders in the shipping industry, particularly on the dry bulk side, are reporting earnings over the next 2 weeks. Now, if we're really lucky, a couple of these will just have horrible short-term quarterly numbers, and they'll drop down to that 50 or 60% of book value where we can become really enthusiastic buyers. We bought one this week at 50% of book value, one of my favorite long-term holdings, really nice dividend yield, what I think is solid management. We added that to the deep value portfolio to take advantage of the pricing in the sector right now. If you've been around for a while and followed me at all, you know I love to follow what's going on with private equity investors. They're very smart, patient money, and when they move into a sector and you see 2 or 3 of them starting to get active, it's time to start to take a look at those stocks. Over the years, they've led us into shipping, they've led us into banking, into the miners and metals earlier this year, and most of those stocks that we purchased as a result, at tremendous discounts to book value, are starting to work out very, very well as conditions get just a little bit better in those sectors. Well, this week, Carlyle, one of my favorite fund groups to watch, announced that they are raising a new fund to buy assets and companies in Brazil. And this is on the heels of a lot of strong local private equity activity in the region. Gavia Investments, Patria Investments, hopefully I'm pronouncing those right, I'm probably not, have both raised large new funds to take advantage of undervaluations in the area. Let's just turn that little phone off. GP Investments, which is one of the leading private equity investment firms, has also said that they're going to increase their exposure to their home country, particularly in the infrastructure markets. Now, we've been in Brazil for a little while now. We started buying about a year ago, so we were early, as we usually are. But I have really strong hopes for our Brazilian holdings. I think they're incredibly cheap. So do a lot of smart private equity guys. It gets better in the short term if we see Dilma Rousseff lose the election this fall, so we'll see if that happens or not. However that plays out, I'm very confident in the long-run future of the Brazilian assets and companies that we own. It's going to be a long, bumpy ride, but I think it'll be a very profitable ride over the long term. Another sector that's starting to get very interesting is the European banks. They're kind of getting that perfect storm of everything that can go wrong is going wrong. You've got the Ukrainian situation, a very, very weak economy. You've got the looming stress tests coming up in October, where they're all going to have to delever their balance sheets, sell off a bunch of assets. Hedge fund guys are running around Europe. They're pretty excited to be buying some of these discounted assets that the European banks are being forced to sell. Many of them, of course, are also coming under review of the Justice Department here in the United States for improper trading practices and a bunch of other things, and they're throwing out some mega billion-dollar fines at some of these European banks. So it's really weighing on them. They're starting to sell off pretty big. They're getting down to the 50% of tangible book value where we start to get really interested. We own a couple. of European banks in the portfolio. It looks like we will probably be adding more before too much time goes by. I noticed yesterday that Deutsche Bank was trading at 51% of book value. At 50%, we're interested. Down at 40%, we're buyers. It's always worked out really well for us. And yes, we are still buying the Greek banks. Somebody asked me about that the other day. Was I nervous? No. Okay, I'm looking at this 5, 7, 10 years out. I think Greece survives. It eventually gets better. It probably never gets great, but it doesn't have to. It just has to get better. The two banks that we've owned are through the recapitalization process. I don't think that they'll have to go back to the market. Should the Greek banks fail the stress test, the guy in charge of the bailout fund there in Greece said earlier this week that, look, if they miss the stress test, they're not going to miss it by much, and we already have money set aside should they need it. So I think it may be, again, the Greek banks could be pretty bumpy. I like that. It gives me a chance to scale in over time. I think 10 years from now, I will be selling those Greek bank stocks that I'm buying for, very low multiples, fractions of book value right now, for huge price increases. The type of hedge fund and distressed money that you saw get involved in these banks, they're not looking for a 20 or 50% return. They're looking for 4, 5, and 10 times their money over time. So am I. I'm very comfortable holding them. I don't really care what the price does day to day in the short term. So the European banks, getting very exciting, very interesting. We'll be keeping an eye on those. Okay, well, as we come in here, it's the first week back after the All-Star break. Baltimore Orioles still in first place, solid 3-game lead. Just had a tremendous road trip that we're wrapping up today. We won 2 of the 3 series. If we beat Seattle today, that'll be 3 of 3. We can get no worse than a split with them. So we've won 2 and they've won 1. Then we come back home and we get 2 more West Coast teams at home, 2 good West Coast teams in the Los Angeles Angels and the Seattle Mariners. If we come out of this week, I think with a winning record over the last 2 weeks, we are in great shape to make a run for that division title. But we can't let up. The hottest team in baseball right now is the Tampa Bay Rays. They're 9-1 in their last 10 games. And wouldn't you know it, here come the New York Yankees in second place, 7-3 out of their last 10. Very hot team. So we got to stay on our A game in order to take the division. Hopefully we can do it because our pitching's actually getting a little bit better. Today, of course, is Hall of Fame Sunday. The Magic Six, Super Six they're calling them, are going in. Joe Torre, Tom Glavine, Greg Maddux, Bobby Cox, Frank Thomas, Tony La Russa. These are the names I grew up watching playing baseball, whether managing or, of course, Greg Maddux was just such an amazing pitcher to watch the way he painted the corner and moved the ball around the plate. This is a fantastic Hall of Fame class. All these guys very well deserved. Tip of the hat, and congratulations, gentlemen. Now, over in the National League, I just thought I'd mention, because one of the best stories of the year, of course, is Hank the Wonder Dog, the little homeless dog that the Brewers adopted in spring training. This was a team that nobody expected to do much. They're in first place, but they were weakening as we got to the All-Star break. But Hank's magic is kicking back in. That team has gone 7-3 in their last 10 games, and they're 3 games up on the St. Louis Cardinals. Wouldn't that be a great story? A last to first, led by a little homeless wonder dog named Hank out there in Milwaukee. That would be a great story. Let's hope it plays out. So, all right, we've got a little bit of a slow book week. This week we've got one title coming out called Back Channel by a Yale professor named Stephen L. Carter, and it's a historical novel framed around the Cuban Missile Crisis. It looks absolutely fascinating. I will be ordering it when it comes out on Tuesday. Now, the rest of the week looks pretty light as far as new books for us recreational and business reader types. However, August looks absolutely fantastic. We have Randy Wayne White coming out with a new book, W.E.B. Griffin, whose books I have just loved over the years and continue. They're just wonderful, easy, fun reads. Of course, all set around the military and World War II primarily. But they're great books, and they're fantastic stories. He writes a fantastic novel. Now, Bill Gates and Warren Buffett have both said one of their favorite business books, and Gates said it was his favorite, was a book called Business Adventures, and you couldn't find it. It was way out of print. Well, that's being re-released in the second week of August. I'll be first in line to get a copy, download that onto my Kindle. When both of those guys recommend a book, I at least want to check it out. We also have, to my wife's happiness in August, we have a new Lee Child, Jack Reacher book coming out. She's a huge fan. There's some interesting titles coming out in August, and of course that will lead us right into the very strong September release season, which includes two books that I'm really looking forward to on the business side. That's Toby Carlisle's Deep Value, and of course Guy Spears' Education of a Value Investor. So only about 6 weeks away from those interesting titles being released. Meantime, there's some great stuff coming out in August to keep us reading all the way through the summer season. All right, we got a great big week coming up this week as far as economic announcements and silly stuff that could move the markets around. We have existing home sales. Everybody's going to be watching that very closely on the heels of that disastrous new home sales report. We'll see exactly how that comes out, what revisions they make to last month, and where we stand on a year-over-year basis, which in my mind is much more important than how we did compared to last month. The Case-Shiller comes out. So that's the only thing that's gone up in the housing market in the last year has been pricing. That's due to all cash and institutional buyers pretty much forcing that key first-time buyer out of the market. And last week we did find out first-time buyers have dropped all the way down to 26% of all buyers. That's horrible. That number is usually up around 40-42%. That, again, because of the job situation, they're just not there. We'll be watching that existing home sales and Case-Shiller number very closely. What we'd like to see is a Case-Shiller that cools off and existing home sales that are a little bit better year over year, but I'm betting that's not going to be the case. All right, we also have the consumer confidence number. That's always a fun one. Almost impossible to predict that number. Sometimes when I think it's going to come out strong, it comes out horrible, but it is a potential market mover, so we'll be watching that one. Then we have the ADP report, which people follow it. I don't know why. It rarely actually correlates with the job number, but it does give us, I guess, some hint of what's going on, and we'll dissect that pretty hard on Wednesday, and that'll lead us into the real jobs number on Friday, and we'll see what the government wants us to believe about what's going on out there in the workplace. Prediction, better unemployment rate, no wage growth. So just because folks got $8 an hour part-time jobs, not to me a sign of a recovering economy, but the market will often take it that way. So we'll see how that one comes out. We have a Fed statement out on the 30th. We'll read that, the periods, the commas, the pauses, the parentheses. That report will just be endlessly dissected as we see what the Fed thinks of what's going on in the economy. In the long run, I don't think it means very much. I don't think it's going to say much different than the last report, with slightly improving conditions across the country, pockets of weakness in housing and construction, but maybe I'll be surprised. We have a ton of earnings reports out next week. Energy's in the spotlight. Now, we've got a lot of energy companies we bought over the last couple of years, so we'll be watching to see what goes on there. Maybe we can get a surprise that creates either some upside in some of the names that we own, or maybe we'll get a blow up or two that we can add to the portfolio. So we'll see how the week develops there. From my point of view, there is a big announcement from Moody's. Moody's is going to release their review of Greece's credit rating. That could drive my Greek banks higher, which I don't mind. I have a nice position in them. If it's a bad report, maybe it'll drive them lower, and we can do a little bit of scale buying in. But whatever happens with that, I expect it'll create some activity for me on Friday when the report is in fact released. All right, that's pretty much all we've got going on down here in Central Florida. We're heading back out to the range to do a little target shooting down here today. Always one of my favorite activities. And then we've got the Orioles and the Mariners later today, the Hall of Fame broadcast that I'm going to certainly try to catch this afternoon. And then we'll head into the next week and see how all this plays out. This is Tim Melvin of the Tim Melvin Deep Value Report and Banking on Profits. Have a great week, everybody.